Have you ever wondered why some people seem perfectly calm when the market jumps up and down while others panic and freeze? Maybe you have asked yourself whether it is better to invest slowly over time or to wait for that one big moment when prices fall and everything looks like it is finally on sale. Today we are going to explore that exact question, and by the end, you will have a clear and simple understanding of two of the most discussed investing styles in the world: dollar cost averaging and buying the dip. And as you listen, I want you to imagine yourself actually using these strategies in real situations, because this will help you see what might work best for you, even if you are just starting your investing journey, or even if you feel like you know nothing about the stock market at all. Dollar cost averaging sounds like a complicated phrase, but at its core, it is one of the simplest and most beginner-friendly investing approaches that exist. It means taking a fixed amount of money and investing it at regular intervals, no matter what is happening in the market. This could be weekly, monthly, or even yearly, but most people do it every month. For example, imagine you decide to invest $200 on the first day of every month. When prices are high, those $200 buy fewer shares. When prices are low, you buy more shares. You do not need to predict anything. You are simply showing up on schedule and letting time do the heavy lifting. And that is exactly why so many people love this strategy. It removes guesswork, it removes stress, and it makes investing part of your routine rather than a big dramatic event. Buying the dip works very differently. Instead of investing consistently, you wait for markets to fall. You might wait for a 5% drop, or a 10% drop, or simply for the moment when everything feels cheap. The idea is that you are buying when everyone else is scared, and you are getting more value for your money. It is a strategy that sounds extremely logical. After all, we buy shoes on sale, we buy phones on sale, so why not buy investments on sale too? The problem is that the market does not give clear signs. It does not announce when a dip is coming or whether the dip you see today will get worse tomorrow. And for many people, this becomes an emotional battle. They find themselves waiting and waiting, hoping for the perfect moment. And sometimes that moment never comes. To understand how these two approaches behave in real life, let us create a simple example with two fictional investors. Meet Emma and Lucas. Both of them have $6,000 to invest over the course of 1 year. Emma chooses dollar cost averaging. She invests $500 every month without second-guessing herself. Lucas chooses to buy the dip. He holds all $6,000 in cash while waiting for what he calls a real discount. Now imagine that in the first few months of the year, the market drops by 8%. Lucas feels excited, but he says to himself that the market will probably fall even further, so he keeps waiting. Soon after, the market rises again. It rises slowly at first, and then all at once after some positive news. But it never falls to the 10% drop that Lucas is waiting for. Month after month, he keeps holding his cash, while the market climbs higher and higher. Meanwhile, Emma is quietly investing her $500 each month. She buys a little less when the market rises and a little more when it dips. She does not worry about catching any bottom. She simply follows her plan. At the end of the year, she has invested all $6,000 and enjoyed the entire journey of ups and downs. Lucas, on the other hand, still sits on cash, waiting for a perfect opportunity that never truly arrived. And while this scenario is fictional, it reflects a very common real-world pattern. Many investors wait for the ideal moment, and because they are afraid to be wrong, they end up not investing at all. This is why so much research has been done on these strategies. One famous example is a study from Charles Schwab that tracked 5 hypothetical investors over a 20-year period, a study also described in your reference file. Each investor received $2,000 every year, and each used a different strategy. One investor, known as Peter Perfect, somehow managed to invest all his money at the exact lowest point of the market every single year. This is something no real person can do in practice, but it is included to show what perfect timing would look like. By the end of 20 years, his investments grew to more than $138,000. That is impressive, but what followed is even more important. Another investor, named Ashley Action, simply invested her $2,000 on the first day of each year. No timing, no hesitation. Her final result was just $10,000 behind Peter Perfect. Considering she never caught a single bottom, that is stunning. Then comes Matthew Monthly, who used dollar cost averaging by investing smaller amounts every month. His total ended up extremely close to Ashley, just slightly lower, proving that consistency works almost as well as investing everything up front. Even Rosie, the investor with the worst possible timing who always bought at each year's peak, still ended with over $121,000. Why? Because she stayed invested instead of waiting for the perfect moment. The only investor who truly lost was Larry, the one who stayed in cash, waiting forever for the right time to buy. He ended up with less than half of what everyone else earned. The lesson here is simple. The market rewards time, not perfection. While lump sum investing and dollar cost averaging both perform extremely well over long periods, waiting endlessly for dips can cause real damage, especially when markets trend upward more often than they trend downward. And this is where human psychology comes in. When the market rises, people fear buying in because they think it will fall soon. When the market falls, people fear buying in because they think it will fall more. Fear pushes them into inaction, which is why dollar cost averaging is so effective. It removes the emotional burden. You do not need courage, you only need consistency. Buying the dip can work, but only if you have two things: extra cash available and the ability to act when things look scary. Most people struggle with the second part. When markets drop, the world feels uncertain. Negative headlines appear. People worry that things will get even worse. And in those moments, the strategy that once felt exciting suddenly feels risky. That is why many long-term investors blend strategies. They dollar cost average regularly, but they also keep a small amount of cash ready just in case the market experiences a significant drop. This is not about timing the bottom, but rather taking advantage of rare opportunities without delaying regular investing. Let us look at another extremely simple example to make this clearer. Imagine you walk into a store every month to buy apples. Normally they cost $1 each, so your $10 buy 10 apples. But sometimes the apples are on sale for 50 cents each. On those days you get 20 apples. Dollar cost averaging is like buying apples every month, keeping your life easy and predictable. Buying the dip is like waiting for the sale, but you cannot know exactly when the sale will happen or how long it will last. If the sale happens while you are distracted, you miss it. If you wait too long for a bigger discount, you may walk away empty-handed. This simple analogy helps you see why both strategies have strengths, but also limitations. Another thing to consider is your personality. If you feel anxious when deciding the perfect time to invest, then buying the dip may not be ideal for you. But if you are disciplined, patient, and unfazed by volatility, buying the dip can be an opportunity to boost long-term returns. Still, even professional investors with decades of experience struggle with timing. The market is full of surprises: a sudden political announcement, an unexpected earnings report, a global event. These things can shift the market in seconds, which is why relying on perfect timing is like trying to catch a falling knife. Sometimes you get lucky, sometimes you get hurt, but most of the time it is simply unnecessary. This is why dollar cost averaging has become so popular among regular people. It makes investing easy to understand. It encourages regular saving habits. It reduces regret because you are not trying to make impossible predictions. And it creates a slow but steady path toward building wealth. Even Warren Buffett, one of the most famous investors on earth, has repeatedly said that the smartest move for most people is to invest consistently in a low-cost index fund rather than trying to time anything. Now, as you think about your own situation, picture yourself 1 year from now. Do you see yourself calmly investing each month, letting your money work quietly in the background? Or do you see yourself waiting on the sidelines, hoping for a big market drop while the months pass by? Picture how you would feel in each situation. Which version of you feels more confident? Which version feels more stressed? Sometimes the best strategy is not the one with the highest theoretical return, but the one that you can actually follow without hesitation. To wrap this up, both dollar cost averaging and buying the dip have their place in the investing world. Dollar cost averaging is simple, reliable, and perfect for anyone who wants to build wealth without stress. Buying the dip can create opportunities, but only if you are ready to act during uncertain times. And remember, the market rewards action, not perfection. Thanks for being here today, and I hope this helped you think more clearly about your investing journey. Stay curious, stay consistent, and I will see you again very soon. Just a reminder, I'm not a financial advisor, This video is for educational purposes only, and any results depend on your own decisions and actions.